Ladies and gentlemen of the crypto space, we're live on a Friday, April 21st at 11:38 a.m. Markets are continuing to go sideways, bit of a crab, bit of an up, bit of a down. It's all volatile. It'll drive you nuts. You have no idea what choices to make, what options to consider, what actions to do. What do you do? In the most generic way I could say it, there's not much to do, but you can consider compounding cash flow. You can dollar cost average. And the most important thing in this, what appears to be very soon to be realized, deflationary currency environment, a recession where there's significant contraction of economic activity, is do you have enough cash? So I'm at the point where I have chosen to not claim weekly income for the first time in quite some time. Now, I don't know if that's going to stay. There's nothing that's fixed or required to be consistent with execution. You could change behavior depending on considerations, but go figure. This past week, I didn't claim. I see the assets that I received income, the denomination of which I received income, and I'm like, why am I selling it? I have enough cash. I got savings. I got savings here. I got savings there. And I didn't even claim because once you claim, you got to do accounting, and that's meaningful. But when I do accounting, I have to convert to stablecoins because I report as income and I want to retain my dollar denominated income. So I'm choosing not to claim. That's my option. I can claim and buy an asset, but now I'm exposing to a volatile asset, and I've tweeted before that I have an inability to hold volatile assets. It's just not necessarily conducive with the way I like to execute in my capital management framework. So do I buy something that's productive? I generally tend to stay away from the liquid derivatives. I don't need more Ethereum. I don't need more liquid staked Ethereum. I don't need anything. You know, a lot of folks want to speculate on growing a particular position. Frax is an interesting position. Curve, convex, and a variety of its liquid derivatives. These are all considerable. Note that the yield has been slowly diluting and then going down meaningfully. So I would expect that actual trend to continue. Um, Urine has been holding up nicely. You always have to consider the swap rate. You get a premium when you swap in because of the particular rate at any given time. And speculatively, so you get a premium swapping in to like a Y curve. And then as the market trends towards peg in bullish times in a year or two, you could get less of a discount swapping out or pay less of a discount swapping out. All the while producing whatever floating rate APR. Apparently, this is auto compounding, which is quite interesting. So the APR is significantly less, probably like 26, 27, and then it compounds into 30-ish. Um, but these liquid types of wrappers give you that type of flexibility. If you need to sell something for cash, you have a capacity to get cash, and you're also exposed to an investment. Um, I don't know. I don't have the answers to these questions, and I struggle with these choices myself. In the end, my choice this week led me to this train of thought, this topic of conversation. Why am I claiming? Maybe I'll end up claiming, and the assets will have depreciated further. So instead of X amount of dollars, it's I'm losing an extra $500 for the week. And um, and then in hindsight, it's a poor choice. In hindsight, if the assets that I received income in are going up in price and I didn't claim, and then I claim yielding the higher income quantity, then I made a good choice. You drive yourself nuts trying to make a good choice or a worse choice or a better choice. So think in terms of free cash. Do you have X amount of dollars now? try and speculate how much you will need going into the future. Do you have bills covered for X amount of time, X amount of months? And if you don't need to claim, and not claiming unto itself is a speculative exposure to a direction. Obviously, it's a long direction. If you're not claiming, you're not locking in the current dollar value at this given time. You are speculating that it will go up in price, and you will only be forced to sell the income for a depreciated price if you need it. So if you don't need it, you have a less of an odds of having to become a forced seller. Well, all things considered, that is actually something I'm thinking about quite a bit. What degree of forced selling may manifest in the crypto markets as compared to other markets? And that's an interesting one, especially considering what we went through in 2022. Um, but there was no failures to the degree that we experienced in the crypto markets in traditional finance. Obviously, you had the banks of this year, but in 2022, those types of systemic failures didn't occur in traditional markets. So we really had a big flush. That was a heck of a forced selling flush for countless reasons, one reason or another. How many forced sellers are no longer in position? So what remains if everyone has forced sold and it's all people that didn't have to sell that are remaining in the market? That's giving you a sense of who your peers are, who is the average actor that you're engaging with, who's the remaining vested interest. I mean, vested interest isn't necessarily negative if you can identify alignment. If you have alignment with vested interest, you're all on the same side and you're all trending in the same direction. Vested interest is not necessarily an enemy. They're not necessarily a predator at any given time, and then it's imperative to identify if they flip predator and then they exit. Obviously, venture capital is a form of vested interest that has a particular goal in mind, and there's different types of venture capital. So depending, they have different time horizons. There's a lot of venture capital just wants to achieve a particular ROI in a particular time frame. Other vested interest might have significantly longer time frames and significantly larger sources of capital. And they're continuously doing raises and they're accumulating, and maybe they're just accumulating assets and these digital forms of currency units, and they're building enterprise. So maybe there is no exit for a lot of capital that's going in. And frankly, all things considered, I think that's a reasonable potential observation. Look how much capital is sticky. So a lot of what we think of from an adversarial perspective is capital going in is trying to reap some sort of capital gain, some sort of ROI, and it's going to end up flowing out. But the real success, the real observation to make of how well a market is maturing is how much capital is actually sticky and being retained by a particular market to continue to engage in economic activity, to have currency units, to engage in various forms of enterprise, to buy things, to incentivize, to pay salaries or whatever, what have you. There's countless different things that enterprises can consider from a treasury perspective. Why do they retain particular assets? What kind of capex will they need to account for in the future? What kind of denominations will they need to have in order to finance that capex? And that's what you're seeing here with the total market cap of stablecoins. That's part of the equation. There is a reason why capital didn't flow out. This quantity of capital didn't flow out. It was needed or desired for one reason or another. This is the reduction of the entire space, the significance of the entire space. This is the difference between 17, 18, and then the slow bleed into nothingness in 2019. There was none of this in 2019. This is new. This is a market. This is a market that captured dollar currency units. And that's overlooked for all the nuance and sophistication of catalyst protocols that are still being built during the bear market. And folks are too specific. They're looking at too much of a myopic perspective on these protocols and not at the system holistically as it's structured, its shape, its composition, its nature as an emerging market. Picture this. This screen right here might as well be a fucking country. Might as well be a country that had some sort of economic boom for a 2-year period, and investors around the world were allocating dollars to that particular country's market. And that market, just like all markets with the higher cost of capital environment, is there's dollar shortage, and capital needs to flow out for one reason or another. And we see the capital flowing out of this market, but the capital is sticky. Why is capital sticky? That is the most fascinating thing, and it's just a number on this screen right here. And it's not the granular what protocol is doing what. It's literally just $131.26 billion. That is the most interesting thought experiment that he can engage in. And it's different. This is different this time. This is so fucking different. It's $131 billion that wasn't here, is now here, and isn't leaving for one reason or another. And this is opportunity, albeit this is a negative sum game. So the prevailing market activity remains player versus player, a predatorial environment of folks being able to capture less and less currency units. So in the meantime, what do we do in a market like that? We try and survive. You need to persist into future market cycles. Every market on this planet is a cycle. So treat it with that in mind, that the cycle will occur in the future in an opposing direction. Policy will change. Various aspects of the market dynamics will change. They'll become more favorable. Capital will start to flow in. And that's inevitable. And the most opportunistic time to be exposed to such a market directionality shift is throughout the entirety. And you want to own things that are going to mature into base layer infrastructure, and they're going to be sticky and attract capital and exist into the future. And all of this accumulates into a market. This is a market. So the start of the stream was compounding. So do you compound? Compound into assets that are speculated to be part of infrastructure, contribute to a functional market. And you compound if it's extra cash. A lot of folks, I'm sure, especially folks that listen to me and other folks in the space, this is their extra money. This is their investment, their savings, their perspective on the future. This is how folks want to achieve something in 3, 4, 5, 10 years. That's probably a good mindset for compounding. Unless you need the capital, why are you selling for cash? And I think that that's quite reasonable. This is probably a time that someone, even like me, that I treat this as cash flow and I use it for expenses that I'm not necessarily claiming, and I'm contemplating the notion of compounding. Compounding doesn't necessarily mean I have to claim my income and reallocate to something other than what the income is denominated in. For me to compound, I'm literally just not claiming. And then the cash flow just grows and grows and grows in its respective denomination. So that's where I'm at mentally. I'm not. You can't force trying to take an action. You can't force trying to find something, find opportunity. Opportunity has to come to you. So for that to occur, you have to survive. And then the entire market goes multiples. 2, 3, 4, maybe 5 years. Maybe it takes 5 years, whatever, however long it takes. Isn't that the market you want to be exposed to? So you have to survive until then. Which is why I favor locked positions. It's not necessarily duration risk. It's guaranteed exposure to whatever the future market will be, and it alleviates the emotional burden of contemplating the various actions to take. It's a translation of a position to a purchase, guarantees future exposure, can sell if you want to. So there goes that. What's the point of? Bear in mind, you also have to have the serenity now perspective. If you can't sell, there's no emotion associated with it going up or down in price. You can't do anything about it. So that, to me, that's the perspective I have, and that's greatly relieving of a great deal of burden and responsibility. I can't do shit, even if I wanted to. All I can do is focus on X amount of cash on a weekly basis. Do I want it in dollar form or another denomination, which is compounding, and I have directional exposure to that particular denomination? And that's speculative because I see a future for these particular denominations. So I literally just don't claim right now unless I need cash, of which I don't right now, so I'm not selling it for cash. I don't know, some shit like that. I'm trying to help you guys out. This is complicated stuff. Rippers in the house, Sir Joe, Raul, Paul, Dan, Asarco, doing very little today, but I caught a live stream. There's not much to do, and that's okay. That's okay. In 2019, late 2019, there was literally nothing. It was the end of that cycle, and it was boring. You had Aave was called Lend at the time. Synthetics was just figuring out what the hell is going on with its initial staking contracts that led into DeFi summer of 2020. Hex came online and everyone was like, what the fuck is this thing? So late 2019, Bancor was doing what it was doing. Kyber Network was starting to come online late 2019. Uniswap had like a $500,000 worth of liquidity on it. It was like, there's nothing. There was no activity. And it was all just what? They were still thinking in terms of ICOs. It was boring. It was people struggling to see opportunity, to find activity. And I felt in hindsight, now I have a very different perspective. Now it's like, that's okay. It's different now. There is a market now. There was no yield in 2019. There was no cash flow. There was no enterprise. There was no captured currency units. There was no analogy to emerging markets. There was no stablecoin narrative with literally folks in U.S. Congress fighting with regulators over the significance of stablecoins in the global financial landscape. That's literally where we're at now. Tell me it's not different right now? That's so damn different. You literally have Congress advocating for the U.S. to get off its ass and for regulators to actually see what the hell is going on with the global landscape of these products and services. So different this time. All you have to do is survive. Great time to accumulate stuff since there's nothing else to do. That's it. So, it's accumulate for what purpose? You have increased exposure to a particular protocol of choice. And these protocols are doing big things. There's a fair amount of governance going on Frax. I mean, USDP is going to be a heck of a swap, and they'll make a lot of income because the yield on USDP comes from treasuries. That's a risk-free asset. Clearly, there's a degree of custodial risk, regulatory risk. But isn't that the nature of what we do is we assess risk? I mean, if they could pull in an extra 20 mil a year, that contributes to an overall significant texture difference to the composition of the protocol. It's hard to define really what some of these protocols are. And that's why I really go for the analogy. And that's why I try to compare something is like something. And, Frax is just such a grandiose protocol and has so many textures and flavors to it. It's not necessarily a stablecoin. It's like a stablecoin derivative, but then you got it's wrapped ETH products. So you're literally talking about like a robust banking operation that's creating bank assets and these derivatives and structured products and And what matters from a banking perspective is how the enterprise operates with regard to its risk profile considerations, how stable and risk considerate it is, and then that's the assessment. And that what they've done thus far is significant. Quantity of protocol and liquidity they have, the velocity of FXS ETH growth is extraordinary, which is expressive of the reception this protocol has to market actors, and it's been received very well. So that seems to be a very interesting asset to compound. Now, what turns me off is there's no significant cash flow to VEFXS. Some of the derivatives and FPIS is interesting. I just like, for instance, why do I always go back to Forex? Because Forex, stablecoin narrative. What if there's 20 trillion, 100 trillion dollars worth of stablecoins flowing back and forth between Southeast Asia and Europe and Africa? I don't give a shit that I'm in the U.S. What I care about is these stable coins are transacting all over the place. I don't even care if it's just entirely Curve. All Curve has to capture is a percentage of the overall market share, 10, 20, 30%, something else. Uniswap somehow is still popular. I just want exposure. All that matters is the speculative exposure to a potential significant increase in the market size. What market size? The number you see on the screen. What if that's 20 trillion? All you need is a little exposure to a market like that, and you're on a whole nother level as compared to any type of equities investment you could possibly think of, and the vast majority of crypto investments you could possibly think of. And that's why we've talked about these analogies. Why? Forex is significant. You can't have exposure to Forex in traditional finance, but you got exposure to it here. What if it captures the attention, the minds, the imagination of financial market participants over the years to come, and it becomes something bigger? So, what do you compound with regard to Curve, the Curve narrative? I mean, you could uh, even Redacted's got all that exposure, and Yearn has such a large VCRV position. Frax dominates convex. Staked Out does what it does. You have the concentrator and Jones and all this shit, and it's just endless. And in the end, you'll all make your own choices. And if you compound it, some sort of liquid derivative, in 5, 10 years, it probably did very well also. Probably does very well. Does it matter if you do very well or very, very, very well? Does it matter if you maxed out your performance? What matters is just having exposure and staying in the market. If you own a certain quantity of assets, you own a certain quantity of assets. And that's that old stupid thing the Bitcoin folks used to say is like, one Bitcoin equals one Bitcoin. Yeah, that's great, fine and dandy, hodl. No. We talk about these locked positions, and yes, you can put it in the frame of reference, the perspective of like a hodl and one curve equals one curve. And no, these are enterprise. It's the analogy, it's the story that's significantly different. It's not much of a financial story with regard to Bitcoin. It's not productive. It doesn't contribute to financial activity. It's a collateral asset, literally a treasury. That's it. That's the entire story. It has a fixed monetary policy, so it invalidates the need for the Fed and monetary policy because it's literally just deterministic monetary policy. And sure, we all understand that that's significant. That's literally the core thesis I tell you guys about these more sophisticated financial products, this deterministic monetary policy and how significant that is. But there's not much interesting to Bitcoin. It doesn't really contribute to robust financial activity. And frankly, I've talked some hot talk that it's a little dangerous. That it's for sure it fits the gold narrative, but it's much scarcer. So there's a greater chance in contributing to wealth concentration than gold ever did. Which basically means the odds are it appreciates significantly in the years. But You guys do capital gains, you guys do trading, it appreciates significantly. You want to buy and sell and figure out how to time markets and all that really frustrating, complex market behavior. That nobody wants to do that. We don't want to do that. That's why I've been talking on this stream for the last couple of years. And that's why I constantly say enterprise over money. Enterprise is a form of savings, cash flow. It adjusts for inflation very nicely, consumer price inflation, and it's exposed to the overall money supply. So it has all the components you need, and it fits the same narrative as Bitcoin because of its scarcity. Enterprise is scarce. You can only break down an enterprise into so many parts, and it's productive, and it's savings, and it allows you to think in terms of egg sandwiches, and that's meaningful. Hope that helps, guys. Vasco, when Moon? No, not anytime soon. Strap in. This shit's going to take a while. Have you looked at the Llamas NFT? Yeah, they're cool. I wish I could get exposure. I'm not really in the market to drop a couple thousand on Llamas right about now. I don't need additional exposure to. But that's cool. Look, I love how it pulls people in to the curve narrative, curve assets, CDX, CRV. That's great. Good. Go get them, llamas. I don't need the llamas necessarily. I do like my Gods Unchained NFTs. I could play with them. And the llamas, I don't need additional productive assets. If anything, it's a great derivative product that's drawing in new participants into the Curve ecosystem, which further strengthens anyone that has the lower level types of products, like a VCRV or a CDX CRV, or some of the initial derivatives or the base layer VCRV. And that's cool. And they're really nice art. So that's interesting. Really like what they did. If I could find one at a decent price, but I'm not going to struggle over it, and I'm certainly not going to spend a fair amount of capital considering market conditions. Um, Eventually, more fees will come to VFXS. That's right. I expect in time as the stablecoin narrative evolves, I expect. Uh, I mean, look, they did gauges a long time ago, so there's a speculative potential for the cash flow of EFXS to increase significantly in the coming years, and that's why I bought the exposure I have. That's why I have the exposure I have. That's why it's locked. I I am guaranteed deterministically to see what these various assets will be like in 2025, in 2030. I'm going to have these assets. The market will be what it's going to be, and I expect the market to be meaningful. My portfolio is measured in terms of weekly cash flow, not at its relative valuation on a week to week basis. Assume good morning. Big ups, Eduardo. Hello, Cap. Grabbing some, be diversified, be smart. Make sure you have enough cash to buy egg sandwiches and stuff. And if you need to sell in the weekly to finance living expenses, then you do that. In the meantime, this is probably starting to be an opportune time to accumulate, to compound these types of assets rather than just sitting on excess cash. So if you don't have excess cash, you probably want to save up buffer. I mean, you probably have 3, 4, 5, 6 months worth of spending cash available. And you got to keep psychologically healthy. Too much work will drive you nuts. So you got to make sure you have enough cash to go on vacations and stuff like that. So you got to think of how you're managing just, the balance sheet, the bank account. To remain in the market, you got to remain psychologically healthy. Big ups. Why is Balancer ecosystem so underrated? People blind, Balancer, Pounder, or Balancer is a big deal. It's small though. Like what, 30, 40, 50 mil a day in vol. That's pretty cool. It's small compared to Curve and let's look at the volumes. Curve cranking out 161 mil a day. Uniswaps at 1.72 bill. Pancake holding on. I mean, this has been the same positioning for quite a long time at this point. Trader Joe is big on Arbitrum. Does a lot of volume over there. And balance it down here with 36 mil, 30, 40, 50 mil. Weekly change down 20%. So these numbers look like they're trending. Crab action, sideways action. It's not like Balancer is better than Curve necessarily, especially with regard to stable swaps. Stable swaps, and that's why Curve is what it is. You got to remember, it's not just technology. Great technology doesn't necessarily overcome existing existing technology, even if the new technology is better. Time in the market means a lot. That's why Bitcoin has the strength it does, and that's meaningful. That's why Uniswap has the strength it does. Also because it caters to the certain demographic, and that's okay. You don't fight the system for what it is. It's how Balance is going to overtake Curve at some point. Trader Joe is going to overtake Curve. The market will tell us what will happen. And if anyone's in a good position to do some nice volume, it's Trader Joe. But how big is Arbitrum going to get as compared to mainnet? Look at the liquidity. The liquidity at Arbitrum is microscopic compared to mainnet. 1.98. Do you guys remember what I said when we were at 2.1, 2.2 billion? That was $200 million ago. $200 million, over 10% of all the liquidity in the network has flown out. I mean, look at this. Look at this day. Where's that candle? Minus $60 million. Do you think that was profits? Maybe you think that was profits flowing out of this micro network of $2 billion. So it was inevitable. A lot of folks made a lot of money. Throw a couple of $1 million over there, you're in charge in a $2 billion liquid network. It's not much liquidity. And then you go back to Ethereum, there's $70 billion. So, Ethereum mainnet is 35 times the size of Arbitrum. Dare we talk about like Polygon 1.47 and Avalanche? These are micro networks. And now they're cool and it's interesting to think about the potential for the network and you can play around, but you got to remember the smaller the network, the more adversaries there are going to be, the easier it is for a predator to operate with a smaller amount of capital. So there's significant risk playing around on Arbitrum. Where's Solana got? 147. Kava, I want to see 158. So I have hopes for the smaller networks. But Ethereum mainnet where the action is, I don't know what the hell the story with Tron is. That's a complicated story. That's more of an Eastern story, so I don't have that story for you guys. 95% tether dominance. Look at USDT versus USDC over the last couple of months. The amount of change filtered by here. Hey, look at that 72. Look at that position of look at that change right there. 82, 48, 54. Oh, USDT has been coming down for a bit. Look at that. 82 down to 72, and USDC has been bumping back up finally. Couple of $1 billion. Is what it's going to be. The composition of liquidity is going to change over time. What's pertinent is the overall availability of liquidity and the flow of that liquidity from one network to another. We saw the flow of capital onto Arbitrum, but now minus 2.21% over a 7-day period. That's capital outflow. There goes the opportunity. That's big liquidity draining, folks. If you're still playing around in Arbitrum, be very careful. This is where the predators and the larger actors are going to take their gains and leave the market. With $62 million having left the market on April 18th, I'm sure a lot of millions of dollars were made that were flowing out. base launching, balancer pools will be a centerpiece to that. It's all part of it. It's not like we can know for certain that balancer and Aura are just going to be massive and bigger than other protocols. What we need to think of with regard to portfolios is exposure. What do you have exposure to? And we've been talking about it for a long time, and we have exposure to that. Bunny's been doing well also because it's been recycling and it's been paying for circulating supply disruption. So that's cool, and that's nice to see. We haven't heard from the solidly forks lately. Things been quiet on the solidly front, and that is a perfect example. Perfect example of better technology does not necessarily make existing technology any less significant. Existing technology has time in the market, and it doesn't necessarily get disrupted, even in the face of better technology. Folks can scream to high heavens about how much they're making with Velodrome. It's a microscopic market. $675 million market. How much opportunity is there? There's not a lot of opportunity. And solidly mainnet obviously has done what it's done, which it just doesn't have the recycling. The transaction fee should have went straight to bribes, and that would have been a very different outcome for the protocol. Curve seems to not be getting a lot of volume on Arbitrum. Do you find this problematic considering it's the leading L2? I'm not too interested in the L2s. I'm more interested in mainnet. I'm interested in where the liquidity is, meaning if we all of a sudden see $5 billion, $10 billion worth of liquidity flow into Arbitrum, then I'll have more interest over there. But right now, that liquidity drained right out. It went in, it came right out. So no. I think mainnet is the biggest opportunity. I think stablecoins are the biggest opportunity in the entire crypto markets. So how do you play stablecoins? Well, how do you play France creating a stablecoin and throwing $100 billion on the network and making financial payments to Britain for international trade using their stablecoin? Well, I'm sure folks in Britain are going to want to swap that stablecoin for, a pound counterpart, a pound stablecoin, or USDT, because USDT works very well in the East. So how are you going to do that? Oh, shit, you're probably going to go to Curve, because they got the liquidity, and you're going to get the good swap rates. So that's the exposure I want. I want just exposure to stable coins and transaction fees. Folks, look at that's the speculative exposure. If you get 3, 4, 5% on transaction fee V curve base fees, yeah, that equation looks a little bit different in 5, 10 years, especially if sovereigns start playing around in these forex markets. So no, uh, I'm not really seeing that as problematic, Django. I think the L2s are significant. We don't know where they're going to land. I think right now it's going to take some years to figure out where these networks are going to land with regard to significance in the overall grand scheme of things. 25 people remaining in the stream. Thank you all for sticking around. 7 likes. Hit that thumbs up button. We can do better. Let's wrap it up for today. We'll look at some charts real quick. I've been eyeing like Stargate. Stargate has such an interesting liquidity profile on all chains. It's kind of like there's a constant buy pressure, and if you look on Arbitrum and like Trader Joe, there's just a constant tick of buys. It must be like the cross-chain arbitrage, and whatever is going on with total liquidity for Stargate. There's something interesting. This is a very unique asset, the way its total liquidity composition across all chains uh, is, and how its price action is. Something is very interesting about this protocol. So I keep my eyes on it. I have just some lock positions, some of the original bond that won't unlock until next year, and in which case I'll just stake it and lock it. And that's the exposure I have there. Aura finally came down to 245 on the defensive. This is a position of support. Support is a position of weakness. Look for you get a bounce here back to 270, bounce here back to 290, and then it goes down to the next level, 220s. And this is a classic structure of a bearish lower lows, lower highs. But that's irrelevant. What's pertinent is, buck 40. You're going to break new lower lows from a 2023 perspective. I would argue that that is unreasonable. It's not impossible, as always, but, uh, what's the difference if you're locked? Or you measure the position in terms of cash flow. You're making an extra 200 bucks a week, 500 bucks a week, 1,000 bucks a week, 5,000 bucks a week. And then the 5,000 turns into 1,000. Oh, the horror. And then the 1,000 in 5 years' time turns into 50,000. So that's the measure that I prefer is the weekly revenue. Um, let Cycling. Look at that. I love that. Look at the horizontal price action between a buck 45 and the 390. And look at Bunny go. Look at Lit go. 85 to what? A buck 50 and it's horizontal price action. You're not looking for price appreciation of the currency assets, of the currency recycler regime assets. You're looking for stability. You're looking for not down. If you're not going down, it's working as intended because it's not for appreciation, it's for financing and it's for cash flow. So this is a different type of asset as compared to many assets. Horizontal price action is exactly what you want to see, and that's exactly what we see here, especially on Curve. As complete horizontal price action since inception. It is refreshing. This looks very similar to this, looks very similar to this. And that's an interesting observation that we've only had 3 years to see, but I look forward to seeing how these charts play out in the coming years. Frax has done a lot of horizontal price action as well. Looks nice. Position of weakness. Watch it bumps up to like 990, and there you go. There's your head and shoulders, breaks down. We get down to like a $6 and change. Hard choices. All right, always respect the portfolio. Crypto conscious, well said. Which means respect the cash. Means you can't spend all your cash, and which means think in terms of weekly cash flow. And you can't spend all your weekly cash flow. You can't invest everything. You got to save some, spend some, invest some. But you want to compound and build weekly cash flow. Cash flow cost averaging, baby. Love it. No more dollar cost averaging, cash flow cost averaging. Friday, April 21st at 12:20 p.m. As always, thank you all for joining me. I wish you the best. Stay rational out there. Don't force activity. Don't force positions. Don't force your hand. The market has to come to you. Don't throw quarters at the train tracks. Put quarters on the train tracks and let the train come to you, which means, sure, it could take a couple of years. Cash flow cost average is an interesting perspective. Be well. I will see you guys after the weekend. As always, you know the deal. After party on Discord for the most rational community in the crypto space. See you then. Peace.